we can start the discussion and continue. I'll try to be very much specific on the topic that we were discussing last week with respect to the banking industry, where we were talking about the structure and competition, how the banking industry has evolved, particularly in recent years, particularly with respect to the financial crisis, where the number of consideration has evolved. So you are basically seeing this financial industry's evolution. So we have discussed more or less towards the latter part of the discussion last time, and if I'm not mistaken, we have also looked at how the banks were responding in terms of these changes that you are seeing, and also the banks started consolidating. That's to say, smaller units of banking become increasingly not cost effective, and as a result of that, they had to merge with bigger counterparts, and also to some extent, as the bank runs, bank failures become a possibility as a method of avoiding such bank failures. Bank regulations prompted some consolidation measures also throughout the world. Okay, but invariably the consolidation also had its demerits. That means you are more or less pushing the banking sector, financial intermediaries, too big to fail. You are creating bigger banks. So this was a kind of, pros and cons if you look at from a perspective of consolidation. But what is interesting here is the entire banking sector was required to kind of, go through some challenging times with the financial crisis, but then they had to respond in line with the developments in the financial markets. Okay. Let's come to the benefits and cost. And before we move into the new lecture today, I again would like to see if you have any questions and any clarifications required. Hope you are seeing the screen clearly today. If you have anything, you can raise it. If not, you can also quote it in the chat box, so I can follow up on the basis of your observation, your comments. So that's been said, I'm just moving on. I hope you are seeing the side that we are discussing. So the consolidation effectively increased the competition, and also, as I was discussing, driving inefficient banks they cannot sustain in such circumstances. Inefficient banks go out of business simply because efficient banks basically, in line with the efforts put in forward by the entire industry, was moving in that direction. So to say that the banks are increasingly motivated to make use of developments in the form of ICT and also shared treasury management systems. So many efficiency-based improvements were introduced, right? So you see this enhancement of competition as one of the benefit, and then as a result, so-called economies of scale and scope. Economies of scale, the scope is in the form of collaboration across the industry, and as a result, the entire financial industry's cost structures have improved. Effectively, who's the beneficiary is the clients and customers who started getting the benefits of more structured, if not lowered, cost scenario. You probably seen, I mean, even now from your own experience, today we don't necessarily require to use one particular bank's ATM. It is a collaborated ATM structure. Multiple banks can have a single ATM structure and they can attend to their banking functions. What it means is it's increased efficiency because single bank would not necessarily be using the full capacity of a ATM machine. So to say that the banks in collaboration now provides these services. And also, if you are using bank A's ATM to transact in terms of your bank B's account, probably the transaction cost previously involved was higher. Now it's been more or less structured. So these are the benefits that you are seeing across the board in terms of some of the consolidation happen in terms of IT aspects. But that is only one side of full consolidation that we are discussing. Consolidation from a broader perspective effectively look at the banks who are not efficient being merged, if not work in collaboration with another financial intermediary, and thereby strengthening their balance sheets and spreading out their assets and liabilities to more orderly financial intermediary operations. Okay. Then, of course, what happened is to consolidation, your probability of failures also reduced. Okay, so you had more diversified portfolio because previously probable reason for you are performing in one direction, maybe you are increasingly kind of a concentrated, not diversified, concentrated to one type of business activity. By bringing in the consolidation, you probably expand the diversification and you become much more capable because you had the expertise in terms of one type of business activity. Your concentration was too much onto that previously. Now you are merging, if not consolidating with another financial intermediary. They are, of course, having some other type of business portfolio. So now you have more diversified structure. So that itself a benefit in terms of the consolidation that's bringing. Okay. And cost in terms of consolidation is smaller type community banks appears to disappear from the financial intermediation and become less attractive and competitive. And also these big banks sometimes are not necessarily encouraging financial intermediary activities to small businesses. They will always focus on big timers, big institutions. So that was a consideration. And also, they are increasingly now getting into more type of business activities. And that itself also creates some additional risk in terms of their portfolios. So this is what you have seen during financial crisis and all, because these agencies have moved aggressively towards some real estate driven activities. So you can see this benefits and cost from a consolidation perspective. I discussed this briefly, but I touched upon this because there were enhanced preference and enhanced push for some consolidation measures in recent times with the pandemic circumstances. So this must be useful for you to again keep an eye on in terms of how recent changes evolve in the financial markets. And this number of insured banks that also reduced to some extent in US in recent years, simply because some of these consolidated banks have become single bank. Many got together and started kind of introducing one bank instead of 3, 4. So these are the kind of circumstances that they are exposing. And then you see the new banking consideration in the form of universal banking concept. It's there, but now it's again becoming much more considerate given the current consolidated, if not interlinked, health-related efforts put in place by the policy authorities. So to say that financial consolidation as well as financial service conglomerates are combining retail, wholesale, then investment banking services, it's a one-stop shop effectively. You walk in, you can have everything, right? You don't need to go to different locations to get different type of banking activities carried out. And this could also have international banking, trade finance, right? And the consultations, advisory services, listing, then of course legal services with respect to financial intermediation. Quite a lot of expansion to this is happening now, right? Even to some extent, you see travel functions also now performed at bank desks, because international trade and international finance probably linked up with ancillary services, right? Even sometimes you see housing finance is separated, but that comes under mortgage. But then, of course, in some financial intermediaries, if you walk in, you will see they also have housing development arms, real estate development arms. This is to kind of get the business more or less carried out in the one and the same location without letting customers shop around, and at the same time kind of promoting a full range of services. So this is more fashionable and easy to some extent. And in the context of COVID and related consideration now, as I was mentioning, again become prominent in today's context. So to say, you can attend to many of your activities from single location. Or now you don't need to physically present yourself. There are online, if not virtual arrangements to attend. Okay, so to say, information technology and economies of scale further helping these arrangements to capitalize in today's financial market. And at the same time, banking activities are more or less linked up with investment kind of activities like securities, trading, securities, platforms. You basically see you are not only a customer because there are, for instance, that's the role of primary dealership in government securities, let's say, and banks. Banks are increasingly promoting their depository deposits for their clients. But when they have the primary dealership, their primary activity is promoting government securities. So when you promote government securities to your clients, you probably lose deposits. So ideally, banks would prefer to keep deposits rather than government securities, because investors, if not customers, directly investing means they get the ultimate return through deposits. What the bank does is take deposits, pool all of them, and then go and invest in government securities and keep a margin and only share balance to the depositors, right? So when you directly promote, you probably lose that margin that you are keeping. But that does not necessarily the case now, because banks are increasingly becoming primary dealers, and also they are the direct agents in terms of promoting financial instruments, financial assets issued by governments, and also that open up another avenue of opportunities in terms of banks to benefit from movements in interest rate, and through which they can gain liquidity and capital benefits. So these are the opportunities that's brought in with the changes happening in the banking or the structure. And also they do, as I was mentioning, a one-stop shop, everything under one roof line. They also do underwriting kind of arrangements. Underwriting effectively to say that they make sure that your required finances are subscribed if you are going to do a direct issuance, and thereby you wanted to raise finances for agency. Yes, investors would invest, but in the event investors invest only a part of the requirements, the balance, they do the underwriting. They take the responsibility, but at a fee. Yes, they do underwriting and they themselves invest. So for this, they require to have legal functionalities. They have their separate legal subsidiaries who attend to this type of activities. And also in terms of engaging in commercial activities by the banks, not necessarily common, but the balance of through this engagement, because you have maximum exposure for subsidiary kind of activities. So the regulators would very closely monitor those stuff. They will have a very close eye on what type of activities you engage. Banks engage in subsidiaries. So to keep the levels up to this level only, you can have your equity holdings, not beyond that. So they will have systematic analysis and define those. Okay. Then the restrictions have now eased to the extent where insurance, finance, leasing, even those activities could come in the banking mix. So there are specialized agencies sometimes created by the banks for that purpose. If not, they do those activities under separate units created under the same umbrella. Okay, so with the universal banking and other kind of activities, yes, you see the expansion and one-stop consideration of all kind of activities being now increasingly becoming fashionable. And I simply see even the pandemic circumstance also now giving a more space and scope for these activities to consolidate. So that also some interesting consideration, I believe, from a very recent pandemic development. Okay, and then of course the banks being also look at the level of ownership, as I was mentioning, right? So to say that there's a proper line of division in terms of authorities rest with bank management versus subsidiaries or other interested companies banks buy, if not invest. So some legal separation is also now being looked at. Yes, they draw, okay, you can't have 30% or more in terms of equities, right? So you draw the line to that limit. Okay, so to avoid that the bank is having a substantial equity stakes, okay, but they allow up to that. Okay, but then of course, even if you are having that ownership stake, you cannot have holding company status. So there are limitations for holding companies on that basis. So even if you invest, you probably not have rights in terms of sitting in decision making, like boards of those companies. That's limitations comes with regulators looking into those details, right? Then you see some of these details. This is thrift saving. These are more or less very fashionable in the US. But with the financial crisis, there's a decline in some of the activities engaged by these agencies. Because the society itself has fashioned in US to the extent where they have these associations, saving and loan associations. So they have their state affiliated approvals, not necessarily the centralized federal approval, national approval. So they work on that basis. So these are effectively not that visible in countries like Sri Lanka, but informally, yes, we have many associations, even cooperative based arrangements. That's there. But in Sri Lanka, to some extent, apart from cooperative society based, some saving and other related financial activities, what we are basically seeing is you often see the unit trust, but it's not necessarily something that popular, despite repeated efforts to facilitate unit trust in this country. Okay. Um, I'm not trying to detail here the credit unions. That also an extension to saving association, saving and loan association. Sometimes these credit unions become popular in US because that had tax exemption built into the industry itself. So they have these facilitation to some extent inbuilt in the structure, and through which operating in that financial market. Okay, but interestingly, international banking that has a rapid expansion with international trade, integration of global communities, and also helped by labor movements, migration, searching employment elsewhere, and education now. So all these combining further expansion to the international banking activities now. Okay, so from another perspective, apart from international trade, existence of multinational corporations. For instance, yesterday also we had some discussions with Bangladesh. Bangladesh, landlocked, not necessarily landlocked. They have Bay of Bengal access to sea routes, but major shipping lines all around the world do not necessarily call towards that corner of the Indian Ocean. So to say that they pass through Sri Lanka, then of course they more or less move into the waters of Singapore and that part of the world, and they do a lot of trade related activities concentrated from Singapore, right? So they have land access, not necessarily land access, more or less other dual shipping, if not transshipment arrangements. But they were also discussing the possibilities of using Sri Lankan ports for such facilitations. And Trincomalee is, to some extent, is a good point, if not Colombo. So they are looking at all these opportunities. That is another expansion I was just highlighting in terms of, the trade related expansions that's possible. And at the same time, multinational corporations. They are not restricted to single jurisdiction. They have their brands everywhere popular. So the people are very much in preference of some of those products. And you have to provide those. So the corporation establishes across the world, of course, with marginal differences in terms of that particular market, but maintaining the basic standards of their products intact. So this also helps international banking to expand fast. And global investment banking, because throughout the world, not all the countries have saving investments balance. You have saving, you have investments, but often you see there's a gap between saving and investments. Even in Sri Lanka, we have a certain percentage of saving, and then our investment requirement is much higher. So we have to see some funds have to flow into the country to balance that. And at times, what you are basically seeing in countries of the developing world is they are dissaving. Governments consuming lots beyond what they earn. So that is a dissaving. So they have to finance them from the private sector. The private sector's savings are being channeled to some extent for government's expenditure. So to say that some requirement of private sector as well as government sector need to be now financed through funds coming in. So that itself become global investment banking activities very profitable and very attractive. So they goes in search of places where they have risk return attractiveness. So it's not just they walk in, they look at combination in terms of what's the risk for the funds that they invest, and then what's the return attached with those investments. So they are more or less looking at these opportunities. And then the euro-dollar market, I have already explained euro-dollar market, where you issue a debt in currencies other than in the country of that currency's origin. US dollar denominated international sovereign bonds we issue everywhere outside US. US investors have limitations in terms of accessing individual investors, but institutional investors can invest. If you are doing that such issuances in US, then you have to have separate Securities and Exchange Commission requirements to follow up. So most of the countries do international currency issuances outside the currency jurisdiction. So it's everywhere. I mean, not only Sri Lanka, all the countries issue euro-dollar bonds, and we have discussed this euro-dollars in our maybe the first few lectures that we were discussing on bond markets and things like that. So you see the expansion that was happening very fast all around the world, right? So okay, so again, you see the euro-dollar market I am explaining here. I would not necessarily try to detail it out. Okay, banks outside US is the major consideration. If you are issuing in US dollar, yes. If you are issuing in sterling pound, then sterling pound denominated deposits held in banks outside UK. Name would not change. It's also right. Euro pound you can call it if you wanted to, but it's the same euro-dollar market that you are tapping. So the basic idea here is you have to make sure that the currency of association has to be outside the currency of jurisdiction, right? So you have to see these elements, very subtle differences you see, but very interesting. And people pick what currency to use in such issues depends on their foreign currency obligations and their international trade related consideration. And most the countries use the US dollar because US dollar is the widely used currency in the international market. Okay, so this euro-dollar market also has the advantage. The deposits maintained outside US in US dollars do not necessarily have stringent regulations, more or less relaxed, simply because most of the countries who has operation and promote US dollar denominated deposits, they promote those. They wanted to attract those deposits because of foreign currency requirements, US dollar requirements. So to say that itself is much more relaxed regulatory environment in most cases, and that also benefits the expansion of euro-dollar market. Okay, and at the same time, US banks not only operate in US, they operate globally. They become international banks, right? So they themselves have established their operations. Even in Sri Lanka, you see US banks are operating. So those banks try to source funds, okay, and they naturally have the access to their own currency, their country's jurisdiction's currency, but they are operating elsewhere. All around the world, these funds are there. So to say that access to those such funds and ultimately that financial intermediary taking them back to their countries is also an avenue through the US banks operating elsewhere, and not only facilitating euro-dollar market, but also some sourcing of funds for US banks also happening here. This I'm giving a hint in terms of how the global banks evolve in recent years. This is 2018 end numbers, but 2020 end numbers also more or less maintain the same structure. So to say that you can see first 4 banks in the world, biggest banks in terms of total assets they hold, are Chinese banks. Okay, so first 4 in the global map, Chinese. The 5th one is Mitsubishi UFJ, that is a Japanese bank. Then you see US JP Morgan, and HSBC is first in Hong Kong, but then subsequently based in Europe, London. But more or less it's a global bank. Paribas is a French. Bank of America. These are all kind of, what you are seeing here is the more or less the strength of assets of global financial system is now rest with some of the Asian economies. So the China is having a significant say in international banking today, simply because of their very big current account surplus. They export a lot compared to what they import. And Japan too have a current account surplus, but they were very strong in 80s, but subsequently the Chinese financial intermediaries expand very rapidly, accumulating assets, resources in the process. This also shows the expansion in line with the global trade and other related global expansion in economic activities. But if you look at the same in terms of 2011, in terms of assets, right? So you see one Chinese bank in 5th place, ICBC. Okay, and then CCBC, that is China again. They are here again, number 8. Mitsubishi UFJ was number 7 in between, right? But most of the banks on top is more or less European banks. This is after the financial crisis, so some of the US banks lost their ground during this period. But you see European banks. But you can see in the previous slide, it's all changed. ICBC, CCBC, they are 1 and 2. And Bank of China has operation in Colombo also now. So you see the level of expansion in line with economic activities happening in the globe. So these are the developments that you can very closely monitor with how the banking systems evolve, how the regulatory structures change, how the competition shape up. So these are very interesting details, very interesting facts you can follow in terms of what you are seeing in financial press. So with that note, I complete this part of the discussion. Before we move into the new topic, that's central banking, would like to hear if you have any questions, if you want any clarification, so we can take up before we discuss the next topic. Thank you. Okay, so we are having more or less approaching towards business end of this program now. I believe you would not have much more time. I'm not precisely sure by when we have to complete most of the classes. But anyway, it would not be more than 4 weeks if I'm not mistaken. I will cross check with IBSL also. But the central banking, very, very important in today's context. And the broader discussion that we are trying to now move in would concentrate in line with the Federal Reserve System. Federal Reserve System is the US central bank, and would be inferring at all points how Central Bank of Sri Lanka also engage, right? So when you see the Federal Reserve System, you can note down how the central bank, if you really wanted to kind of compare those elements being discussed. But the central banking is more or less today's financial markets, as well as the broader macroeconomic per se, is the center of the economic decisions and economic directions in which countries are moving in. Most of the time, the central banks are empowered with either stability objective or growth objective, or thirdly, a combination of both, right? Even in the case of US, the central bank, US Federal Reserve, has the growth objective embedded. They talk it in terms of full employment. Full employment of US resources, in the sense they have to make sure the policy is being driven to attract the US employment being maintained very closer to a natural rate of unemployment. Various ways through which they can attend to it, but that's a kind of a broader direction. But then, of course, you see Reserve Bank of India, they have multiple objectives. And in this case also, despite full employment, they also have multiple objectives. India's case also, it's multiple objectives. They can do many things under the Reserve Bank legislation. And then, of course, even in the case of Sri Lanka, you probably see we have both growth and stability objective, right? Economic growth as well as stability, financial system and economic stability. So you see these elements, that's everywhere in central banking acts, and some central banks attempted in recent years to concentrate purely on price stability. That means maintaining low and stable inflation rates. Even Sri Lanka's context, price stability is one of the objectives. We look at price stability as one of the objectives, but at the same time, as I was mentioning, economic stability also play financial system and economic stability, that also play a role in the case of Sri Lanka. So you can expand into these with greater details as we move on. And as I already mentioned, among the most important players in financial markets throughout the world, central banks remain at the center. Okay, and the central banks are often the government authorities in charge of monetary policy. Okay, so to say that central banks' actions effectively direct interest rate, that's the kind of, the price of money from another perspective. Also from the perspective of amount of credit That is the quantity of money available in an economy in the sense of money supply. The amount of credit extended also the central banks look at in terms of their open market operations. I will come to those open market operations as we move on. We will be getting into those details too, right? So all these interest rates, credit available in the economy, and the money supply have direct impacts not only to the financial market but ultimately to the aggregate output, that is the more or less the GDP, and also inflation, that is price level. So you can simply see from this sentence itself, when you see you are tightening, that means you are increasing interest rates, you are reducing money supply, you are reducing amount of credit available in the economy, that would have negative repercussions in aggregate economic activities, and from another perspective, inflation. So the central banks all around the world look at the parameters of inflation and aggregate economic activities and make their policy decision in terms of their justifications or the legally empowered mandates by making use of these elements: interest rates, the credit, and the supply, money supply, to make sure that the inflation output or other multiple objectives envisaged upon them being achieved, right? To understand the role of these central banks play in financial markets and overall in the economy, we, through this discussion, if not throughout these programs that we were following for the last few months, we have to kind of get a feel on how these central banks work. We look into the background in terms of who controls central banks and who determines the actions, right? What motivates their behavior, and then, of course, the power structures and things like that. These are very concentrated towards more or less so called central bank independence and things like that. So we will touch upon those also to some extent, right? In this particular discussion, we look at the institutional structure of major central banks, right? And we focus particularly, as I was mentioning, in terms of Federal Reserve, the most important central bank in today's context, given the clout it has in terms of the financial markets and the resources it's manage. Okay, so we start this discussion by getting into formal institutional structure of the Federal Reserve. Federal Reserve we shortly call Fed. Fed is Federal Reserve. Okay, and then examine more relevant informal structures that determines where the power within central banks or the Fed lies. Okay, we also look at who makes the decisions. You'll have a better idea of how they are made in these discussions, and also we look at other few central banks also while we are moving on. And throughout this discussion, I will infer in terms of, as I was mentioning, the Central Bank of Sri Lanka structure too. So looking at the origin, okay, so the origin of the Fed Reserve System, you see at the very beginning of establishing a central bank in US, there were resistance. US was not a kind of centralized power. They are worried. I mean, they have different states spread out in the continent. So they were worried about giving power to a centralized arrangement. So they had this fear for quite some time. And also they were worried, I mean, the moneyed interest, when the finances come into play, distrust, although you have empowered some establishment, but money is in the front, money centered, probably they would act upon their self-interest than everybody's interest line. So this was widely keeping establishment delayed in the US case of a central bank, even towards latter part of 1800s, right? But then, of course, the financial markets or the financial intermediation prevailed in US at that time. They also recognized the fact that there was no lender of last resort. There's no godfather they can come when things go wrong, right? So rest of the world, particularly in Europe, they had this structure. Bank of England, we know in 1693 they have established, right? So in Europe, they had these systems coming from ancient days. We discussed about some of those in our previous discussion. So there were no lender of last resort facilitation in US, and this has actually made bank panics or bank runs a reasonably regular occurrence in US. In states, you probably see the numbers we have highlighted in one of the charts in my previous interventions. But what I'm simply trying to say is there was a common regular occurrence in terms of some of the bank failures and the bank panics in US at different times during this period, because there was no lender of last resort to kind of hold, and even FDIC was not in existence, Federal Deposit Insurance, the fallback. But interestingly, 1907 panic, the very beginning of 20th century, prior to World War One, you see there was a panic in the banking system in US. So this was so severe that the public was convinced to great extent that they need a central bank. US public was convinced. They need a central bank because they have seen the trust among financial intermediation is also dropping because these bank failures and bank panics. So they thought central bank in the eyes of lender of last resort and some other functions, and more or less there's a demand establishing towards early part of 1900s because of this panic. As a result, in 1913, Federal Reserve Act was passed. And the Federal Reserve Act, US Fed Reserve Act, give more or less decentralized concentration, because I said at the very beginning, there was a resistance. They feared the centralized power because there were different states in US. You see, in the West Coast, all these states, they were worried about the interest of East Coast. East Coast is where you see Washington, New York, all these states that you are familiar with. And then, of course, in other parts where they are linking with the Central America and Latin America, they had different interests. So they worried about the class power. So the Federal Reserve Act give some understanding in terms of the the decentralized structure in the Federal Reserve establishment. So to say that the understanding in the US was very much in terms of helping out in establishing the central bank by giving credence to the statewide requirements in terms of considerations that were there at the beginning of 19th century or towards the latter part of 19th century. But interestingly, this leads to look at, let's say, Central Bank of Sri Lanka's case. So we see in Central Bank of Sri Lanka's case, establishment of the central bank was in on the basis of Monetary Law Act number 58 of 1949. Okay, so the Central Bank of Sri Lanka was actually established in 1950, August 28th, operational establishment, but the empowerment in terms of the legal jurisdiction is the Monetary Law Act number 58 of 1949. Okay, so we'll come like that. We will see in the case of Sri Lanka with the independence in 1948, there's the requirement of establishment of a centralized central bank. Again, in Sri Lanka too, there were consideration for lender of last resort, but more than that, in the case of Sri Lanka, at that time it was to make sure orderly structuring of the financial intermediaries operating in Sri Lanka at that time, and also we had international trade already built in, but more or less our financial activities were handled through India and London. So to say the centralized colonial administrative powers were concentrated here, but after the Second World War, UK was gradually giving away independence to most of the colonial locations that they were administering, also helped in terms of independence and subsequently establishing the central bank in the case of Sri Lanka. But we'll come to that. We haven't had a interest in terms of decentralized push. There was no such fear also for centralized push in Sri Lanka, like other countries, even in India and to some extent in Pakistan, there were notices of such fear of centralized power due to various reasons. But we have seen Central Bank of Sri Lanka was established in 50 based on Monetary Law Act number 58 of 1949. So the Fed Reserve in 1913. So likewise, you see, there were kind of, considerations that despite all the happenings that you see in the Atlantic Ocean and the countries in Europe and US during this period, central bank in the form of a Fed Reserve came into existence in US in the 1900s, not before that. So it's very recent in that sense from a perspective of how it's gained momentum and control of global financial markets now. So how this structure, how the Fed Reserve is structured, right? So you see here, the writers of the Fed Reserve Act, they were mindful of the fear of centralized power sounded by US states. So they wanted to diffuse power along regional lines. So they had East Coast, West Coast, the central part of the country, then the boundaries to the Southern America. So see, they were having all these considerations, and also they wanted to see, they wanted to have the power to some extent balance between private sector and the government among bankers, business people, and the public. Because you see, you will come to these details. The structure was established to some extent to see the balance being brought in on different state priorities on the regional power bases of US, and also to bring in public and private engagement in the Federal Reserve Act itself. This initial diffusion of power, the decentralization of power has resulted in evolution of the Federal Reserve System to include three main entities. And this is very important. These three main entities, Federal Reserve banks. It is not a single central bank in US, but you see number of Federal Reserve banks in operation, but coordinated, collaborated through Board of Governors of the Federal Reserve System. That's the second important component. And then Federal Open Market Committee, FOMC. Then you see Federal Advisory Council, that is to bring in so-called private and public engagement. And then you have members. The commercial banks are members of this Federal Advisory Council, numbering close to 3,000 commercial banks in the US. The number of banks, what you hear is the biggest international banks, but in regional lines, there are a number of financial intermediation in US. It's very significant in numbers, and they are ultimately members of the Federal Reserve System itself. So the Federal Reserve System is effectively a combination of central banks, numbering to 12 central banks. We'll come to those details. Then you have the Board of Governors of the Federal Reserve System. That's the centralized decision-making body and authority. And the Fed Open Market Committee, FOMC, that is the most important open market desk in the world. That's to say that implementation of decisions arrived at Board of Governors into the financial system is carried out by the Fed Open Market Committee, FOMC, situated in New York. That's the New York Fed Reserve Bank's open market operation desk. So then the members. And interestingly, in the case of Sri Lanka, we do not see different central banks operating on regional lines here. What you are seeing is regional officers of the Central Bank of Sri Lanka operating for certain regional functions. Those functions also not necessarily the key functions of the central bank's operations, but more or less facilitation to key functions and regionally concentrated activities. In the past, of course, some check facilitation, check clearing arrangements, currency distribution, and things happen. Today, those become not fashionable because all these things happen electronically through centralized arrangements in terms of new payment platforms, payment structures. Clearing and Settlement Corporation of Sri Lanka, that was established. Central Bank is the major stock or the owner of that. So that's look after the settlement of the checks and things like that. Then the currency distribution is such effective that the all distributions happen through the center here to the head quarters, if not head offices of financial intermediaries. They themselves have their own distribution channels. And more or less, the regional setup in the Central Bank of Sri Lanka is to facilitate geographical based information collection, dissemination, public awareness, such possibilities being looked at. But the Central Bank of Sri Lanka's case, very similar to Board of Governors of the Fed Reserve System, they have so-called the Monetary Board of the Central Bank of Sri Lanka. It's the Monetary Board in line with the Board of Governors of Fed Reserve System that you are familiar here. Then, of course, we also have open market operation activities, but more or less, Federal Open Market Committee is more or less falls in line with the Monetary Policy Committee of the Central Bank of Sri Lanka, MPC. So the advisory councils, what you are seeing in US, is not that fashionable here, but we have both monetary policy consultative committees as well as financial system stability consultative committees. Monetary Policy Consultative Committee, Financial System Stability Consultative Committees in Sri Lanka. These two committees look into the aspects of bringing in inputs from private sector and other different stakeholders in the economy's perspective into the monetary policy and financial system policy decision making. But unfortunately, how professional these inputs is still questionable, because often what we see is the committees concentrate not necessarily macro considerations, but more or less micro, if not their own self-interest driven considerations. The members, they're supposed to represent the sector or the stakeholders in the economy, but unfortunately, they're keen to represent themselves. So there are ways through which you can figure it out. These committees operate in this country too, right? So you see the Fed Reserve Banks, the Board of Governors, the FOMC, the advisory councils, very much established within the structure of Fed Reserve System itself. In the case of Sri Lanka, there's no structural recognition to some of these elements, the branches, the regional officers operating in Sri Lanka. Law doesn't specify, but it's a decision of the Monetary Board. But the Monetary Board being empowered to take all that decision and established within the MLA with substantive powers with respect to the central bank functions embedded in the law. So that's the broadly the kind of a contrasting and how to look at the MLA versus Fed Reserve Act. So you see that structural details. Before I move into this figure, any questions? You can even write down and send in the chat mode if you wanted to clarify anything. But at the same time, if some of you have joined a bit late today because we started the class at 7 a.m. today, please check with IBSL whether you have any recording available for you to follow up what we have discussed pretty much in terms of the banking industry. So the banking industry, we were talking about the consolidation in great details. Then, of course, international finance and universal banking. These were the developments we have seen in recent times and gained substantive momentum. So that's very helpful in terms of how you wanted to see the entire banking structure evolve over the years. So that details would be helpful if you can follow up with the IBSL, and I also mentioned to them in case some join late, they can have the access for those recordings. That would be very helpful in line with the presentation and the materials that we have shared. Now we started discussing the central banking. I was talking about the establishment of the Federal Reserve System. Federal Reserve System is the US central bank. Also, I was comparing and contrasting Monetary Law Act, under which the Central Bank of Sri Lanka was established. Okay, so the Federal Reserve System, as I was explaining, mainly comprised of three components: the Board of Governors, the Federal Reserve Banks, and Federal Open Market Committee, FOMC. And then you see advisory councils and member banks. Those are more or less interlinked in the exercise in the case of US. But what is interesting here is, as I was explaining, on regional lines in US, they have established several, they have established, in fact, 12 in number, Federal Reserve banks. 12 Federal Reserve banks in US. We'll show those in US map, don't worry. But what I'm simply saying is, it's a collection of central banks, Federal Reserve banks in the case of US. And the centralized structure of this different regional Federal Reserve banks operating in US is the Board of Governors. They are based in Washington, right? So the Board of Governors is similar to, as I was mentioning, Monetary Board of Central Bank of Sri Lanka. Federal Reserve banks, 12 Federal Reserve banks that we were discussing in the case of US here, is no similarity to regional officers in operation with respect to Central Bank of Sri Lanka's regional presence. You can't compare. What regional officers does is merely ancillary functions, whereas Federal Reserve banks are performing substantively complete central bank operation in those jurisdictions, in those regions in US. But when you look at the Board of Governors, they have 7 members, including the chairman, and appointed by the President of the US and confirmed by the Senate. 7 members, including the chairman, appointed by the President and confirmed by the Senate. In the case of Sri Lanka, the Monetary Board has 5 members, including the governor as the chairman and Secretary to the Treasury. In the case of Sri Lanka, Secretary to the Treasury as an official member. Whoever holds the position of Secretary to the Treasury or the Secretary to the Ministry of Finance, by virtue of occupying that position, become a member in the Monetary Board. The governor is the chairman, and then we have 3 appointed members. Right? So in the case of US, The chairman is appointed and the members been appointed by the president with the consent of the Senate. In the case of Sri Lanka, government is appointed by the president with the recommendation of the minister in charge of the subject finance. And then, of course, there's a Senate, like Parliament confirmation. Anyway, the secretary is appointed by the president through establishment of ministries, and that also now vetted through the Parliament high post committees. And the appointment of the members, 3 independent members, also in the case of Sri Lanka, been communicated through the president with the recommendation of the Minister of Finance, and that also vetted through the Parliament high post committees. So you see, most of the time, these important decision-making bodies in the central banks, now in the case of Federal Reserve, as well as now we discussed about the Central Bank of Sri Lanka, has some similarity in terms of recognition under the law, as well as in terms of appointment processes. So the Board of Governors, what you are seeing here is, includes the chairman in the case of Fed Reserve, and currently it is Mr. Jerome Powell. Very, very powerful voice in terms of making decisions with respect to the global markets, financial markets. They come out and speaks. We will come to those details as we move on. But very interestingly, any comments from them being looked very seriously by financial markets all around the world. And the role of governors too, very much similar in other countries, including Sri Lanka. Their observations, their comments has wider repercussion in terms of how financial markets behave. So you know Jerome Powell now, he's the head of the Fed Reserve, he's the chairman of the Fed Reserve. Prior to that, there was this lady Janet Yellen. She is currently the secretary to the Treasury in US. Prior to Janet Yellen, it was Professor Bernanke. He was running the Fed Reserve for quite some time, right? So you see, I mean, these were prior to that, Alan Greenspan, famous names. But what I'm simply saying is this Board of Governors and Central Bank's Monetary Board in the case of Sri Lanka has some similarity in terms of their roles. And here in US, it's 7 members. Then you see the next component, as I was mentioning, 12 Fed Reserve banks. Each bank has 9 directors, right? So who appoint the president, these 9 directors pick one of them as the president of this Fed Reserve Bank. Right? So president and other relevant key positions of operations with the Fed Reserve Banks, they appoint. Then what is interesting here is the Federal Open Market Committee, FOMC, that's where the decisions taken by the Board of Governors being channeled, if not implemented, in terms of whatever repercussions to the financial markets and the entire economies, not only to the US in today's context, has all the members of the Board of Governors as members of the FOMC, plus 5 presidents of Fed Reserve banks. You see 12 Fed Reserve banks where each bank has 9 directors, one of them being appointed as president. So only 5 of these 12 Fed Reserve banks represent in the FOMC committee. And always, president of the Fed Reserve Bank of New York is a member. FOMC main desk is in New York Fed Reserve, and the president of the Fed Reserve New York is always a member of FOMC alongside 7 members of the Board of Governors. And then 4 other Fed Reserve Bank presidents, they come in to take memberships on a rotational basis. So FOMC has 12 members, 7 Board of Governors members, and 5 presidents of Fed Reserve Banks. Always Fed Reserve Bank New York sits there, and 4 others on a rotational basis. So that's broadly the composition of these entities. And then you see member banks, you see about 3,000. We looked at those details in our previous slide. They send 6 directors to the Fed Reserve Banks, because in the US, as I was explaining, the Fed Reserves are owned by member banks, not only the government, but also the private sector. So there's a very big member community, financial intermediary community. They are the owners of the respective Fed Reserve Banks. They send directors to the respective Fed Reserve Bank. They send 6. Right? So the balance 3 usually appointed by the Board of Governors. So each bank's 9 directors basically comprise in that mode. Then the advisory council, you see, from each Fed Reserve Bank, there's a 1 member. These are not presidents. It could be other senior officials of respective Fed Reserve Banks. They are the advisory councils sits in and advises the Board of Governors, Fed Reserve Banks, and each Fed Reserve Bank represent there. They broadly look at the economic aspects of the US in consideration for decision making. So this composition, the structure, is quite interesting, because we will come to European Central Bank. The European Central Bank also, to some extent, established in the lines of Fed Reserve Bank's decision-making hierarchy. But what is interesting after all is, you can see here the structure, but through this structure, the execution of policy tools, right? So the execution of policy tools is very, very interesting, because through these policy tools, the central banks influence the entirety of economic activities in any economy. And even in the case of Central Bank of Sri Lanka, the same policy tools, maybe the names in which that we call them slightly differ, but essence is the same. When it comes to reserve requirement, that is the reserve the banks have to maintain with the central bank, a certain share, if not certain percentage of deposits that they undertake. Any deposits that banks receive, let's say 100 rupees. In the case of Sri Lanka, you have to keep 4 rupees with the Central Bank of Sri Lanka. It was 2% until 1st of September this year. That's why I was repeatedly asking you all to read central bank announcements, particularly the monetary policy announcement. Right? So those decisions were arrived, and it was increased from 2 to 4% on 1st of September. So 2 rupees of every deposit, 100 rupees deposit the banks collect, has to be maintained in the central bank. And now it is 4 rupees in the case of Sri Lanka. In the US, it is very small, very close to 1%. At times, They don't keep any deposits also, but generally there's a deposit. So this is called reserve requirement. And in the case of Sri Lanka, it is called statutory reserve requirement. Be directly under the purview of board of governors or the monetary board, then the monetary board makes the decision and ultimately respective line departments implement. Then you see open market operations, buying and selling of government securities often by these agencies, central banks. But the open market operations is effectively signaling in terms of injection and absorption of money into the financial system. Injection, you supply money, new money to the economy by purchasing government assets. That means treasury bills, right? Or there are other forms of repurchase agreements and things like that. Okay, so to say that they buy government securities from the market and equivalent amount of domestic currency being issued to the financial system. As a result, money available in the system increases. Then that is an injection. Absorption is you withdraw already available money stock in the economy. The central bank holds government securities in its portfolio. They sell treasury bills to the market. Market gets the treasury bill. Money now in the circulation in the economy comes back to the central bank. So you absorb. Right? So they mostly use government securities for this purpose because government securities are considered the highest rated in any economy and default risk free. We discussed these things, so I'm not repeating those again. Right? So to say that the central bank has this role, they play these open market operations to inject and absorb, through which available quantum of money in the economy being managed. That's one objective. But similarly, through such interventions, central bank also maintains where the interest rate, short term, particularly overnight interest rates to be maintained. Because central banks also signals the policy interest rate, that is the discount rate. In the case of Sri Lanka, this discount rate is known as overnight deposit rate and overnight lending rate. In US, this is the discount rate, they call it Fed market rate, Federal Reserve interest rate, or Fed rate in short. So when they see the Fed rate is higher than what they think, they inject money. They buy securities from the market or from the government and inject money to the system, thereby increasing the money stock in the US and rest of the financial world. As a result, Fed market rate lowers, reduces, because you have more liquidity now than demand for liquidity. So naturally, the price or the interest rates changes. So the interest rates reduces, price increases. Right? So then what happened there is through which they inject. So similarly, if they want to increase, they would do the opposite. So you can figure it out now. The open market operation, discount rate, reserve requirements are the tools, apart from some non-conventional tools we will be discussing in our coming few interventions. So these are the elements central bank uses to drive the economic activities in the direction envisaged, and in the direction they think the economy is required to shape up given the developments in the broader macroeconomic per se. So you can now see the Fed Reserve's open market operations, Fed Reserve's reserve setup, and Federal Reserve Bank's discount rate decisions again implemented through Federal Open Market Committee (FOMC) in the case of US has different magnitude and different influence across the global financial system. But we also in Central Bank of Sri Lanka too, similar arrangement is there, but our influence is mainly to the domestic economy. Our changes would not necessarily have much influence to the rest of the financial, because our influence to the rest of the financial structure in the world is very minimal. To say it's very insignificant, but to say that Fed Reserve it is very much, even Sri Lanka is looking at Fed Reserve's decision with respect to open market operations and discount rate policies. And the reserve requirement is often regularly adjusted phenomena. You adjust once and let that to settle. You can't adjust every day. So you normally you see this being adjusted once in many years. Of course, you can have more frequent adjustment if required, but generally this being adjusted once in a few years' life. So to say, this is generally the structure that you will see in the Fed Reserve, and you have now compared that with the Central Bank of Sri Lanka's possibilities too. Any questions before I move on? Okay. Then you see the Fed Reserve's existence in terms of 12 Fed Reserve banks in US. Each Fed Reserve bank is more or less concentrated in line with regional priorities as we were discussing. And you can see from this US map, these numbers, 1, 2 red numbers that you are seeing on the screen here, are Fed Reserve districts, right? Fed Reserve districts boundaries are these red lines, right? So what you are basically seeing is most of the Fed Reserve banks are concentrated to the East Coast at the establishment and even now, simply because this is where the Atlantic Ocean is. This is where the US trade and other financial linkages with Europe. Europe is in this side. It is from East Coast of US is very much easily accessible. So the global trade moves very much in this part of the ocean. And now, not only that, there are other interlinkages and establishes the entire financial market operations favored establishment of Fed Reserve banks also at the inception itself in favor of East Coast of US. And you see these districts 1, 2, 3, 4 up to 12 with boundaries earmarked in red lines here, demarcate one particular Fed Reserve bank in the US, numbering to 12, and concentrated very much in line with the economic concentration prevailed in early 1900s. You can see these white lines within this US map. Much it is very much representing in the states in US, different states. These are state boundaries, like provinces in Sri Lanka, right? So number of states are much larger than Fed Reserve banks because few states been pooled and established one Fed Reserve bank in some regions, particularly with respect to the West Coast, where you see number 12, where it comprises of many states, the famous states in that part of the US, including California. So you can see it here. So what you are seeing here is the Fed Reserve banks on the basis of Fed Reserve districts. And the star, red star that you are seeing here in Washington, that's where the Fed Reserve Board of Governors sits, closer to the political authority, political center, the presidency White House, and the Capitol Hill, where the US Senate is located. Then you see here the blue dots. That is where within the district, the Fed Reserve Bank is located. For instance, Fed Reserve District 12, you see the Fed Reserve Bank is located in San Francisco. Whereas in Fed Reserve District 1, you see Fed Reserve Bank is located in Boston. Number 2, you see it's in New York. Okay. So likewise, you see Fed Reserve banks are located across all these Fed Reserve districts, numbering to 12. But you can see within the same Fed Reserve Bank district, there may be number of branch cities. Those were recognized by black dots. In the Fed Reserve District 12, you see you have 4 branch cities, Fed Reserve branch cities, whereas center is San Francisco, that's where the Fed Reserve Bank is. Similarly, even in the case of Fed Reserve Bank number 5, that's where the Washington is also, you see the Fed Reserve Bank is located in Richmond, whereas the branch cities in Baltimore and Charlotte is there. So likewise, the structure in US is the collection of central banks or Fed Reserve banks concentrated on the basis of regional preferences at the time of establishment and to diffuse centralization of power. But then, of course, the Fed Reserve Board of Governors more or less take concentrated, consolidated decisions on the entire US Fed Reserve system and the banking and financial system, through which it influences the global financial markets immensely. And what you are seeing here again, you don't see in Sri Lanka. We don't see central banks distributed across regional lines in this country. It's the one central bank, but as I was explaining, not all the provinces have regional officers in the case of Sri Lanka. There are few regional officers very much in line with the regions where they wanted some representation. For instance, in the southern part of the country, we have a regional office in Matara, right? Then you have a regional office in Trincomalee, you have a regional office in Matale, and we have a regional office also in Kilinochchi. So to say that the operations of certain regional nature, including awareness, information dissemination, information gathering, right? That type of activities being facilitated through these regional structures. Then about these Fed Reserve banks of these structures, you see these are public, quasi-public institutions, as we were explaining, owned by both private commercial banks in the districts as members of the Fed Reserve System. They are the members, the private commercial banks. So they own these Fed banks in their respective districts. As we discussed, they select 6 directors for each district. The balance 3, because each Fed Reserve district or the Fed Reserve Bank has 9 directors, 6 appointed by these member banks and 3 appointed by Board of Governors. That's to say that the member banks appoint directors to represent the banking as well as from the perspective of their regional priorities, right? So these directors would not be one type. For instance, if that Fed Reserve district is concentrated heavily on industrial sector, industrial production and things like that, they favor 1 or 2 industrial representatives becoming the members of the board, simply because that particular Fed Reserve district needs to prioritize the requirements of those industries. If you find Fed Reserve districts in, let's say, the California that might be US in promoted, of course, then the tourism, services, financial industries concentrate. If it is the East Coast, again, very similar, including trade, because that's where the opening up to the rest of Europe is much more closer. From west side, yes, now you see with respect to the arrangement, they would be looking at the economic activities with rest of Asia too. So the representation of Fed Reserve districts represent the particular district's economic specialty to great extent. And the 3 members look at and appointed by, let's say, the Board of Governors are more or less independent authorities, not linked with any member banks, or they are not officers or employees of those financial intermediaries operating in those, to avoid any conflict of interests, right? So that's the kind of a setup with respect to the Fed Reserve banks that you see in US. So similarly, as I was mentioned, this membership and representation being concentrated to some extent in line with their constituencies' interest. Okay. So the appointment is again on the basis of Board of Governors approval and by the President of the bank. So you see that Fed Reserve Bank's operation again goes to the center. That's the Board of Governors, through which they operate in the case of Sri Lanka. It's the monetary board of the central bank. So major 5 functions they perform. Right? So they perform number of very interesting functions, and you can see number 1 and number 2, that's broadly the structural elements. From 3 to 7 are the major 5 functions the Fed Reserve System performs. And some of these functions actually This is a PDF, so you can't go and see the videos, but you can actually go and Google it, so you can have the video and you can kind of get a feel also. So to say that conducting monetary policy, that's the key function of all central banks around the world. So the Federal Open Market Committee, FOMC, sets US monetary policy in accordance with its mandate from the Parliament or the Congress, as I said, to promote maximum employment. Maximum employment often represent the full employment in terms of the labor force in any country. To take out natural rate of unemployment, labor in transit, all kind of things. So generally, natural rate of unemployment is usually about 4% of labor force in many countries. And that means to say that unemployment in US should not be much deviated from 4 to 5% to say that they are full employed. So this changes from country to country, but generally that's the lowest level of unemployment you see in most cases. Could be even smaller, but generally that's the case. Then stable prices. That does not mean same prices. Stable, that means very little volatility in price structures. That means low inflation and moderate long-term interest rates in the US economy. Yes, central banks target only the short-term interest rates. They cannot necessarily target long-term interest rates because long-term, many things could happen. But through short-term interest rates, they effectively influence the price levels. Because you influence the cost of financing through interest rates, quantum of money available in the economy, in addition to that, forward guidance and other moral suasion, various other policy tools central banks uses, through which you make the cost of financing to be at certain level in the current sense. But what you are effectively doing is you are trying to maintain low and stable inflation rates. So if the inflations are high, you probably tighten the monetary policy by increasing the interest rates. So that means today's interest rates are higher means future inflations are lower. Right? So you are basically fighting future inflation by adjusting your cost of money, cost of financing now. So through which you bring the orderly price structures in the economy, and as a result, you probably see the medium to long-term interest rates align, not necessarily high as short-term interest rates at times. The yield curves could be more or less flat, if not downward sloping. So that's the conduct of monetary policy. And in the case of Sri Lanka too, the conduct of monetary policy happens very much in line with the open market operations, in line with the monetary board directive, monetary policy committee's inputs being looked at, and the mandate for the Central Bank of Sri Lanka is price stability and economic price stability and financial and economic stability. Price stability is low and stable inflation. Financial stability is financial system stability, where the banks and other financial intermediaries required to have public confidence in the financial intermediation. And economic stability is generally in line with overall productive resource availability in Sri Lanka to be used in productive economic activities without having much more volatilities and swings in business cycles. So the conduct of monetary policy is broadly on that basis. Then the financial system stability. The Fed Reserve monitors financial system risk and engage at home and abroad to help ensure the system support, because US banks are not only limited to US jurisdiction, it's everywhere. So anything happens outside US for the financial intermediaries of US origin would fall back, because it's been the money of investors, US investors, they are the owners of those financial intermediaries. So that falls back to the US economy. So they make sure the system supports a healthy economy for US households, communities, and businesses. So they wanted to see the operations of US financial intermediaries, not only in US, but outside US too, ultimately beneficial to the US economy. Even the operations outside US, indirectly, they signals they need to employ US people, but US does not strictly kind of enforce such, because it's attract expertise, talents based on the capability, merit. So that would help them to effectively utilize the resources that they employ. And Sri Lanka too, the financial system stability is one of the key element where the financial intermediary is being monitored to make sure that the risk tolerance are in line with the overall risk preferences, and also to make sure systematic elements, macro prudential considerations are met. So we see that other elements we will also see. I simply see it's requires some explanation for you to kind of get some details. So this ideal point for me to stop our discussions today, and we will come back and continue. And hopefully, I mean, if I can finish at next lecture, I will move into the monetary policy operations or monetary policy tools that we discussed briefly today in greater details in our next lecture. So with that note, any questions? Any further questions? If not, we can stop at this point, and whoever joined late for today's discussion, you can actually follow the recording possibly available. I'll also mention to IBSL, you also can follow up. And also IBSL told me there is a form uploaded in the system, that is evaluation form. You all can also look into that, and it's a very brief, I believe, few minutes you have to spend and complete it and submit for their own assessments of things. That being said, if you don't have any further questions or any clarification, we can stop at this point, and we'll meet next week. And most likely next week also, I would start at 7 o'clock. So please pass that message across. That would make little early than usual, but that is very helpful, because I may require at times to attend some of the official engagements in the morning itself. So we will have lectures from 7 to 9. It gives you also a little more time to concentrate, but maybe sometimes I might be keeping you all up little early, because everybody wants to have a rest on Saturday, I believe. Yes, but little sacrifice that would help everybody to kind of move on. Thank you, and stay safe.